In previous lectures, we've seen how to translate the expectation of uncertain future cash flows from a specific investment into an equivalent sure value today. The key to this method is using an appropriate discount rate. To adjust for the fact that the cash flows are risky or uncertain, the discount rates must reflect risk. That is, the discount rate should be used to be the same as what a person could earn by putting their money in alternative investments that are equally risky. If you could get more elsewhere, you wouldn't want to invest in the specific investment you're considering. That is, if you put your money into that specific investment, you'll be incurring the opportunity cost of foregoing alternative, perhaps superior rates of return on other investments. Thus, your required rate of return on any investment should equal your opportunity cost, holding constant the risk of alternatives. Thus, throughout the rest of the course, I'll be using interest rate, discount rate, opportunity cost of capital, required rate of return, all to mean the same thing, namely the rate that you should use to discount uncertain future cash flows. One of the most important issues with this approach is the determination of the risk in an investment. And as we will see, the issues that bear on this question, what is risk and how to measure it, will take many lectures to lay out. In this lecture, we'll start by the process of understanding what risk is. For this, the lecture will examine the basic notion of value in a corporate setting. That is, given this notion, we'll examine where risk might reside. In particular, we will examine how risk gets allocated amongst the claimants of the firm on the balance sheet. Here we'll examine the weighted average cost of capital. We will also see how the structure of the financing of the firm, that is the firm's capital structure, how that affects who bears the risk in the firm. To start, we need to consider the general relationship between the cash flows of the firm and the value of the firm. The value of the firm as an entity derives solely from its ability to transform a bunch of stuff that's worth X into some other stuff that's worth more than X. The firm's management adds value only if the present value of the expected cash flows exceeds the certain value it paid for the inputs. This difference is known as the net present value, or NPV for short. The only way to get a positive NPV is by buying stuff for X that generates future and uncertain cash flows that are, in present value terms, worth more than X. If it doesn't do that, then what the firm is doing is not worth doing. So what does this have to do with the price or the value of the stock? Let's turn to that next. But first, note that I asked a very particular question. What does NPV have to do with the stock price of a company? To understand that, we need to consider how firms raise the X dollars in the first place. Stock is just one source of money for management. It represents only one kind of claim to the cash flows of the firm. The structure of the claims issued to raise the money to fund the projects that produce the future cash flows is extremely important for understanding the risks to each of the types of the securities that you might buy. In general, there are two types of financial instruments or contracts that are issued to raise money to fund a firm's activities. They're stock or equity, which is ownership, or bonds and debt, which is borrowing and lending. Recall that a bond is a fixed income instrument where the seller promises the buyer a fixed set of payments. Bond owners have no control rights, but they do have priority over equity. As discussed previously, bond owners face default risk and interest rate risk. In contrast to bonds, a stock or equity is partial ownership in that company. As such, equity holders get what is left over after the firm pays its bills. And these bills include payments to the firms, to other firms, and to people that supply the inputs to the firm's process. Once it pays the bills to the suppliers and it sells what it produces, it makes profits. And from these profits, the firm must make payments to the debt holders that lent the money in the first place to create that venture. And if there's anything left over after the debt holders are paid, then only then do the equity holders get anything. Thus, sometimes you will hear equity is referred to as a residual claim. In return for getting leftovers, equity holders have control rights. That is, they have a say in how the firm is run. Since they get whatever is left over, they want to make sure that the management does not waste their resources. Unless 3 martini lunches produces leftovers, equity holders want to be able to rein in such practices. The management of the firm gets the money from selling debt and equity and then tries to transform it by creating a unique combination of people and capital that will produce profits into the indefinite future. The cash flows from this transformation created by the firm are distributed back to the debt and the equity holders. By the way, the government also gets some in taxes. We'll have to discuss this a bit later. For this lecture, let's consider there being no government. Since equity is a residual claim, the return on equity is going to depend upon the return on the firm's assets, the whole, and the level of debt or other liabilities, the amount of the whole that is promised to somebody else. A firm's balance sheet is a summary of the value of the assets and the liabilities of the firm. Let's look at a few simplified, stylized balance sheets to get an idea of some of the most important relationships that exist. Here I want to focus on the value creation process, not on the accounting. The accounting issues are clearly important as they help you figure out how to interpret financial statements of the firm. Most of the accounting issues concern how to account for the economic benefit and cost of something when it actually occurs. For example, to reflect the deterioration of a piece of capital equipment over time, even if the firm does not incur an expense to fix it, accountants will recognize this depreciation. The amount of depreciation they recognize is based upon some conventions, for example, something like straight-line depreciation, that may or may not reflect the actual depreciation of the value of that equipment. Thus, the accounting numbers reflect accounting conventions rather than the truth, although the conventions are typically designed to reflect when a benefit or cost is economically incurred rather than when it is actually incurred. For now, we will focus on some relations that must hold for the market values if investors, debt and equity holders, could see through the accounting conventions to see the actual value of the various elements. So let's consider a firm that was just started. Think of a small entrepreneurial startup where the numbers are in millions, not in billions. The firm has raised $200 million in capital by selling claims to the cash flows from the venture. It has sold debt worth $150 million, and the owners of the firm, the entrepreneurs and their partners, have put up $50 million. Initially, they go out and they buy some raw materials worth, let's say, $100 million, and some equipment worth another $100 million. Given the riskiness of the venture, the debt holders require a 5% interest on their debt claims. The equity holders demand 25% interest. As we will see, their returns are going to be risky. So in order to induce them to want to invest, they need to get a higher expected return, else they would not invest their money there. Let's say the debt holders only require 5% because they view their claim as risk-free. As we'll see, we'll have to figure that out in a second whether it is actually risk-free or not. For now, let's assume that there's enough value in the firm that if the firm needs to be liquidated in any way, they have plenty to be able to pay back the debt. Thus, the debt will be risk-free. The weighted average of the two required rates of return is thus 0.75 times 0.05 plus 0.25 times 0.25 is equal to 0.1 or 10%. The weights, the 75% and the 25%, are the relative amounts of money raised by each type of the security. 75% was in the debt, that's the weight that was applied to the 5% required rate of return on the debt. And the 25% was on the equity, that was the percentage that was applied to the 25% return on equity. Often financial professionals refer to this mix by discussing the debt-to-equity ratio. In this case, the debt-to-equity ratio is 3 because the debt is worth 3 times more than the equity. The 10% in this example is called the firm's cost of capital. It's the return that must be promised to all of the claimants in order to get them to fund the firm's activities. Now that the firm has material and equipment, it can do its magic and transform these items into new stuff that will generate future but risky cash flows. Let's say that on average, the $200 million worth of stuff generates an average return of, say, 10%. Then when we discount back the future cash flows from the firm that it generates, what is the value we're going to get? Here's a really important point. What is the risk of the cash flows generated by the firm? My claim is that in an efficient market, it must be such that the discount rate is 10%. Okay, why? Because the debt and the equity holders are the ones that collectively bear the risk. In a bit, we'll discuss how the risk is distributed amongst the various claimants, but for now, think of the bondholders and the equity holders being the same people. That set of people gets all of the cash flows from the company. Thus, if there's any variation in the future cash flows, they're the ones that have to live with that variation in what they get. So if the risk is such that the discount rate is 10% when they bought the firm's liabilities, then we should also discount back the expected cash flows from the capital and the ideas of the management at a rate of 10%. If the capital and the ideas of the management generate a 10% expected increase over the initial value of the assets, then the present value of the cash flows from the transformation is simply what? The original $200 million. In that case, the debt holders get their 5% and the equity holders are going to get their 25%. The market value of the debt is still $150 million and the market value of the equity is still $50 million. No value was added, and that's because the market was efficient. No one made an excessive return. But what if the market is not efficient? What happens if someone with a good idea buys $200 million worth of stuff that can produce future cash flows that are, generate a 12% coupon, but has exactly the same risk that something that generates a 10% return would have? In that case, the firm sells $150 million in debt, the entrepreneurs add their $50 million on their own. What happens to the value of the debt and the equity after the firm makes this transformation? If the firm takes the $200 million and invests it in the capital equipment and raw materials and people that generate a 12% return, then what will you get in the future on average? Just to keep things simple, let's consider a one-period model. The $200 million in assets, once the firm does its magic, will generate what? A value of equal to what? $224 million, or 12% bigger than what it initially was. And that's what would be the value now. Given the riskiness, we need to discount that $224 million back at what? 10%. So the present value is simply $224 million divided by 1 plus the interest rate of 10%. That equals $203,636,363. In that case, what is the debt worth? Well, the debt is still worth $150 million. The debt holders are going to get their promise payments, whether the assets generate 10% or 12% return in the future. Thus, their claims are risk-free, and they should only get the risk-free rate of return of 5%. What's the equity worth? It's worth the difference between the value of the firm's assets, which is what? $203.63 million, and the value of the debt, which is $150 million. Thus, the initial investment of $50 million by the entrepreneurs of the firm is worth what? 203.63 minus 150. It's equal to 53.63 million. Note that if there was no valuable transformation, the equity holders would have received a fair rate of return of 25% even if their 50 million stayed worth 50 million. In the case of the valuable transformation, the equity holders get more than 25% since they're getting what? 3.63 million more in present value terms. What happened here is that the management of the firm, the entrepreneurs, exploited a positive NPV investment within the context of the corporate form. In the next lecture, we will discuss something called the present value of growth opportunities, which is this effect in spades. Next, we need to take a closer look at how risk is allocated amongst the various claimants. There are two main reasons to understand these relationships. First, you need to be able to keep track of who bears the risk in any business. If you're investing in that business, you need to know what risk you bear when buying one of the firm's securities. Second, the market data from other comparable firms can be very useful for assessing the return you should get on a firm in which you're thinking about investing. When looking at the data of other firms, you will see significant differences in the capital structure of these firms, and, as we will see next, the capital structure of the firm can obscure the information you can glean from market data on whether the return on the firm you're considering is appropriate or not. Specifically, if you want to price the stock of one company by looking at the returns of stocks of other companies that have similar risk, you will need to adjust for the capital structure differences between these two comparable firms. To see the effect of capital structure, let's go back to the original balance sheet when there was no excess return to be made. But let's use the balance sheet to see who gets the risk. Since equity is a residual claim, the value of equity is the value of assets minus the value of liabilities, E equals A minus L. If the value of A or L changes, E changes in response. Most people are used to thinking of risk in terms of not getting what they expect in the future. But keeping track of that kind of information is really kind of messy. So instead, what we're going to do is we're going to use the present value notion to boil down all of these potential outcomes in the future to a value now. So when I say something changes, I mean that there is new information that allows us to update our predictions of future outcomes. And when that new information arrives, the present value of our predictions also change. Thus, the risk contained in any security can be captured through the present value notion by how changes in present values affect the current value of that security. Looking at the original balance sheet, what happens if the value of the assets increases to $220 million because of good news? For example, it's now very likely that there will be a change in regulations that will make your firm more profitable. Recall that originally the equity was worth $50 million and the debt was worth $150 million. When the assets increase in value to $220 million, the equity value rises to what? 220 minus 150 to $70 million. This happens because the value of the debt remains at 150 because it is risk-free, and it is still risk-free. When the good news arrived, the equity value increased by, 40%. 70 minus 50 divided by 50, 0.4, 40% increase. Okay, so what happens if there's bad news? For example, there's some medical study that indicates the product that your firm produces clogs arteries eventually. With this news, the value of the inventory falls to, say, $80 million from $100 million. They're not going to be able to sell artery-clogging products for as high a price anymore. What happens to the value of equity? E is going to fall to $30 million. The assets are worth $180 now. The debt is still worth $150. So equity is equal to 180 minus 150. It's now equal to 30. With the drop in equity value, the equity gains 30 minus 50 divided by 50 equals negative 0.4, or it loses 40% in value. Notice that the possibility of such good news and bad news has no effect on the value of the debt. Unless the value of A falls by more than 50, the value of the debt will be unaffected. Thus, equity acts as a buffer, taking the first $50 million in potential losses first. If the value of the assets falls below 150, then the equity is completely wiped out and the value of debt is then reduced. For the purposes of this example, let's say that such a drop in value is impossible. If this is true, then the debt is risk-free, and the return the firm has to pay its debt holders in order to induce them to give up $150 million is going to be what? The risk-free return. In this example, 5%. Also in this case, all of the risk is in the equity, and that's why they require 25% return. Next, let's consider the effect of leverage. Let's consider what happens if the firm becomes more levered. That is, it increases its level of debt. Just to isolate the effect of such a capital structure change, we'll consider something called a pure capital structure change. A pure capital structure change is when we simply change the capital structure without affecting the assets of the firm. Most capital structure changes are also accompanied by investments in the firm. If the firm sells some corporate bonds, they increase the amount of debt relative to the equity, and they take the money raised, for example, and develop a new product or expand into a new market. If the firm sells equity, it uses the proceeds to build a new state-of-the-art manufacturing facility somewhere. So it changes the value of it changes the nature of the assets that the firm has. For a pure capital structure change, we're only going to change the capital structure without changing the assets in the firm. When a firm does these kinds of investments, right, we can isolate the effect of just the capital structure. Here I just want to focus solely on the effect of a capital structure change without the nature of the firm's business changing too. To do that, we'll consider a situation in which the firm raises money by issuing securities and then immediately pays out the proceeds to retire or reduce the amount of another security. For example, let's increase the amount of debt and use the proceeds to pay out a one-time cash dividend to the equity holders. Specifically, let's raise $10 million in debt and use it to pay out a one-time dividend to equity holders of $10 million. Then on the balance sheet, the debt will increase from $150 million to $160 million. Since the $10 million in cash is not in the firm, we paid it out, the assets of the firm has not changed. And since the firm owns something worth $160 million, and the value of the assets is still $200 million, the equity holders' claim has now been reduced from $50 million to $40 million. It's been reduced by the amount of the extra debt that we raised. Are the equity holders mad? No. While they have equity that's worth $10 million less, they also have $10 million more in cash in their pocket. So they are not mad. All that's happening is we're just swapping something worth $10 million, their equity, for something else worth $10 million, cash. The most important thing to notice is that the risk of the firm has not changed. The risk of the firm has not changed. And that's because the actual real assets have not changed. The firm does what it did before the capital structure change. But under this new capital structure, what happens to the return on equity if there is good or bad news? First, consider if there is good news. Remember the regulations, they got more favorable. And the value of the inventory rises from $100 million to $120 million. Let's say the plant and equipment is generic, so it doesn't change. In that case, with the good news, the value of assets rises to what? $220 million, just like it did previously when the firm had less debt. In response, the equity value will be $220 million, the value of the assets, minus $160 million, the value of the debt, equals $60 million. Given this good news, the equity rose 50% in value, from 40 to 60. So 60 minus 40, all that divided by 40, that's 0.5, or a 50% increase. Recall, prior to the firm changing its debt-to-equity ratio, the return from such good news was only what? It was 40%, or 20 over 50 million. Next, consider if there's bad news. The product clogs arteries, and the value of the inventory drops to 80 million. Then the assets are worth only 180 million, the debt remains risk-free at a value of 160, and the equity falls to 180 million minus 160 equals 20 million. That is, the equity falls by 50%, from 40 million to 20 million. Recall that prior to the firm changing the debt-to-equity ratio, the return on such bad news was what? Negative 40%, not negative 50%. Thus, the return on equities are levered in the sense that they're more sensitive to the value of the assets. Thus, more debt is used to fund the asset. If more debt is used to fund the asset, the more sensitive the value of the equity is to changes in the value of the firm. More leverage can make equity have higher returns when the asset values increase, but more negative when the asset values fall. Next, let's consider how the capital structure affects the cost of capital. Recall that the cost of capital of the firm is the return that must be promised to the claimants in order to get them to want to fund the firm's activities. What happens to the cost of capital as we change the capital structure? If the firm is financially sound enough that it will never default on the debt claim, then the required rate of return on the debt is still the risk-free rate of 5%. But because the shareholders of the firm has residual claims, they will require a return that is commensurate with the risk of the equity. As shown with the balance sheet examples previously, the greater the leverage, the more sensitive the equity is to changes in asset values. And the more sensitive the equity is to changes in asset values, the more risk the equity has. Thus, the required rate of return for equity must be increasing in the leverage, increasing in the debt-to-equity ratio of the firm. So let's look more closely at what happened to the cost of capital. Let's say that the value of the firm will never drop below 160. The inventory of sold, as doorstops is worth at least $60 million. Even after the firm increases the level of debt, the debt remains risk-free, just as it was before the firm levered up. Thus, the required rate of return demanded by the bondholders is still the risk-free rate of 5%. But now, the firm is paying 5% on $160 million out of $200 million, rather than just $150 million out of $200 million. Has the cost of capital gone down? If yes, why? If no, why? The firm is now paying only 5% on more money that it raised. It must be cheaper, right? Wrong. And here's why. Because the equity is more highly levered, it is riskier. Thus, the equity holders need to have a higher return than when the firm had less leverage. Even if the firm raises more money via cheap, low-risk debt, the risk of the firm is now concentrated into a smaller equity stake. Since we're considering a pure capital structure change, in which we didn't alter the total risk of the firm, the cost of capital, which is comprised of the average return on both the debt and the equities, must be the same as it was before the capital structure change. The risk borne by the $200 million initially, $150 in debt and $50 million in equity, is still borne by the $200 million, but now it's $160 in debt and $40 in equity. If the required rate of return on the debt is still 5%, then the required rate of return on the equity must go up by exactly the amount that keeps the weighted average cost of capital the same. Prior to the capital structure change, the cost of the capital was, let's call it R in it. It's equal to 150 divided by 200, all that multiplied by the cost of the debt, 0.05 for 5%, plus 50 divided by 200, all of that multiplied by the required rate of return on the equity. The initial amount was 25%. You take the weighted average of that, that's 10%. After the capital structure change, the new cost of capital, let's call it R new, must be the same as the original. That is, R new must be equal to R in it. The new cost of capital is going to be equal to what? It's going to be equal to 160 divided by 200 times 0.05 for the risk-free rate, plus 40 divided by 200 times R times the new return on equity. So RE, new, is the new required rate of return on the equity. The new required rate of return on the equity must be such that the old cost of capital of 10% is equal to the new cost of capital, again, of 10%. If we solve for that, what we see here is that the required rate of return on the new equity is no longer 25%, it's gone up to 30%. And then if we take this weighted average of 160 divided by 200 times 0.05, that's the weight that comes from the debt multiplied by the rate on the debt, plus now only 20% of the capital in the firm comes from equity. Take 0.2 times the 30%, we see that the weighted average cost of capital is still 10%. In general, the required rate of return on the equity is the following function of the required return on debt, the required return on the assets, and the debt-to-equity ratio. The return on the equity has to be equal to the return on the assets plus the ratio of debt to equity multiplied by the difference between the return on the assets minus the return on the debt. The required return on the assets, RA, is the amount that the investors have to get if they owned all of the assets of the firm. In the example, this is the 10%. Given the riskiness of the cash flows generated by the assets from the firm's management, then the return must be 10%, else it's not worth doing. This expression says that as the firm levers up and DE gets bigger as D grows and E shrinks, the required rate of return on the firm's equity must rise. So let's say that you're looking at two firms in the same business, say two fast food hamburger chains. You notice that the stock of one of the chains has generated a much larger return on average than the other one. Is that stock that you want to invest in? It might just be that the chain has significantly higher debt to equity ratio, and as a result has to discount the price of its equity sufficiently to generate a high enough return on the equity to induce the equity investors to invest. While it may have a higher return, it may also have more of its risk concentrated in each of the dollars that equity investors invest. Without looking at its capital structure, you might wrongly conclude that you want to invest in the chain with a higher average rate of return. This lecture has shown that the required rate of return on securities depends upon the capital structures of the firm. We last considered how the equity returns on two firms that are essentially in the same business can be very different solely on the basis of differences in their capital structure. Both can be efficiently priced, but one will have a much higher return on equity than the other because it has higher leverage. What you need to be able to do is compare the return per unit of risk to see which is the better deal. In subsequent lectures, we will develop an explicit way to calculate what's the return per unit of risk.